Welcome to The Explainer. Today we are diving deep into the mind of a legendary investor, Howard Marks. We're going to unpack his powerful mental toolkit, which is just essential for anyone trying to make sense of, well, this incredibly uncertain world we live in.
So, to get inside the mind of Howard Marks, you have to start right here with this quote. He uses it all the time because it just perfectly captures the central problem we all face. The future is a giant question mark, and yet we have to put our money to work for that very future.
And that's the big question, isn't it? It's the fundamental challenge for any investor. And Marx's entire philosophy is basically his answer to this question. It's not about having a better crystal ball, it's about having a much, much better way of thinking.
So how does he do it? Well, his answer begins with this really crucial skill he calls second-level thinking. The idea is actually pretty simple. If you want to get results that are better than average, you just can't think like the average person.
And this just lays it out perfectly. First-level thinking is the simple, superficial stuff. Hey, that's a good company, I should buy the stock. Easy, right? But second-level thinking, that's where the magic is. It goes deeper. It asks, okay, it's a good company, but does everyone else already know that? Is it already priced for perfection? And then what happens?
And this is really the bottom line. Second-level thinking is your edge. It's about thinking more critically, more thoroughly than the crowd, and then having the guts to act on that insight, especially when it's uncomfortable.
Now, once you start thinking on this deeper level, it forces you to completely rethink one of the most important and honestly most misused words in all of finance: risk. And getting this right is absolutely crucial.
See, for Marx, risk isn't about how much a stock price bounces around from day to day. That's just noise. The real risk, the thing that can actually ruin you, is the chance that you will lose your capital for good.
And this is where he really breaks from the pack. For decades, academic models told us that risk is volatility. Why? Well, honestly, because it's easy to stick in a spreadsheet. It's measurable. But Marx argues that just because you can measure something doesn't make it what matters. The real danger isn't the bumpy ride. It's driving off a cliff you didn't see.
This leads to one of his most brilliant insights, what he calls the perversity of risk. It's totally counterintuitive. So let me ask you, when do you think the danger is actually the greatest?
And there's the answer. Risk is at its absolute highest when it feels the lowest. When everyone is optimistic, when everyone feels safe, when asset prices are soaring, that is the precise moment when investors are usually taking the biggest risks, and they don't even know it. Complacency is the real enemy here.
Okay, so if you've got this new definition of risk, how do you actually use it? Well, that's where his contrarian's toolkit comes into play. These are practical tools you can use to manage that risk and find opportunities everyone else is missing. Now, these aren't just a bunch of nice quotes. You should think of them as a concrete checklist for making smarter decisions. You know, a fantastic company can be a horrible investment if you overpay for it. And on the flip side, an overlooked, unloved company can be an absolute home run if you get it cheap enough. It's all about the price you pay.
All right, enough theory, let's make this real. We can actually see Marx applying this exact toolkit in his recent commentary on the S&P 500. It's a total masterclass in second-level thinking. So the first-level thought is pretty obvious, right? You look at the market, you see the Magnificent Seven, these incredible companies that have driven massive returns. They're so big now that they make up a mind-boggling 1/3 of the entire S&P 500's value.
But here comes the second-level analysis. Marx looks right past those shiny objects. His real concern, it's not the 7 huge companies. It's the other 493. He points out that the average valuation for the rest of the market is well above its historical average. And to him, that's a huge red flag. It signals widespread, maybe even dangerous, optimism baked into the entire market. And all of this leads us to the final, and maybe the most important piece of the toolkit. It's not about mastering the market. It's about mastering yourself. Because, let's be honest, the biggest risks often come from right between our own ears.
You know, the biggest variable isn't what the market's going to do next. It's your own emotional discipline. It's about having the humility to admit you don't know the future. It's about having the temperament to be rational when everyone around you is either panicking or popping champagne. That's way more important than being the smartest person in the room.
And if you remember one single thing from all of this, let it be this quote. It sums up his entire philosophy. Preparing doesn't mean you guess the one right outcome. No way. It means you build a portfolio that's tough, that's resilient, one that can do reasonably well no matter which future shows up.
especially the one you never saw coming. So that leaves us with a question for all of us to think about. In this world full of unknowns, are you spending your time trying to predict, or are you focused on preparing? Because in the end, that choice might just be the most important one you make. Thanks for joining this explainer.